The Indian rupee just slipped past 90 to the US dollar for the first time. If you have all your money parked in traditional Indian investments, you're probably looking at the headlines and wondering if your savings are actually safe. This chart shows exactly why that panic is setting in. The top line represents a 1 lakh rupee investment, growing at a seemingly solid 12% over 5 years in India. But look at the second line. That's the exact same investment converted back into US dollars. Because the rupee weakened from around 75 to 94 in that time frame, your actual global purchasing power didn't grow by 12%. It grew by barely 2% a year. We call this widening red area the real return problem. Over the last 3 decades, the Indian rupee has depreciated by an average of 3.5% to 4.5% every single year against the dollar. When your currency loses value like that year after year, it acts as a silent, compounding tax on your purchasing power. A falling rupee is a structural wealth transfer that forces you to completely rethink how you calculate the real value of your returns. The strange part is, the Indian economy itself is actually doing well. GDP growth is strong and corporate earnings are healthy. The currency weakness we're seeing is driven by external pressures, not an internal economic collapse. A major factor is the trade deficit. India imports roughly 85% of its crude oil, along with massive amounts of electronics and critical inputs. The country needs dollars to pay for all of this cargo. That constant, heavy demand to buy dollars in the global market pushes the value of the rupee lower over time. Then there is capital flight. When the U.S. Federal Reserve keeps interest rates high, global investors pull their money out of emerging markets and move it into U.S. assets for safety. In just a few months, foreign investors pulled billions out of Indian equities, converting their rupees back to dollars and accelerating the slide. For everyday citizens, these external forces create imported inflation. Even if you never leave the country, the price of your fuel, your electronics, and your children's foreign college tuition all go up automatically as the currency slides. Because this depreciation is a predictable, long-term reality rather than a sudden crisis, passive saving in a single currency doesn't work anymore. You have to actively hedge your portfolio. For retail investors looking to protect their wealth, the most aggressive defense is what we call the growth hedge, investing in U.S. S&P 500 feeder funds accessible right from India. This strategy gives you 2 engines of return. You get the historical growth of the top 500 U.S. companies, plus a currency bonus. If the U.S. market grows at 13%, and the rupee depreciates by another 4%, your total yield in rupee terms bumps up to around 17%. But there is a major trade-off. You are exposing yourself to the full volatility of global equities. If the U.S. market crashes, your portfolio takes a direct hit. This makes it completely inappropriate for any money you need to spend in the next 5 years. If you cannot stomach that kind of volatility, you look towards strategy 2, sovereign gold bonds and physical gold. This is the traditional stability hedge. This chart shows the structural, multi-year upward trend of the gold index. Because gold is globally priced in US dollars, its domestic price in India naturally goes up whenever the rupee weakens. The trade-off here is growth. Gold perfectly preserves your capital during crises, but during normal market conditions, it often moves sideways. You get stability, but you sacrifice the aggressive compounding you'd see in the stock market. You have to make a deliberate choice. Do you want to compound your money with high volatility, or do you want to perfectly preserve your capital with slower growth? There is a third option for domestic investors: export-heavy Indian equities. This means focusing on sectors like IT, pharmaceuticals, and specialty chemicals. The math here is straightforward. These companies earn their revenue in strong US dollars, but they pay their employees and operating expenses in weaker rupees. Every time the currency falls, their profit margins automatically expand. However, this strategy requires severe sector concentration. If you load your portfolio with these stocks, you become highly vulnerable to a global tech recession or sudden pharmaceutical regulatory hurdles. Finally, for business owners actively importing or exporting physical goods, there is strategy 4, active forex hedging. This involves using financial tools like currency futures and options to lock in a specific exchange rate. It provides absolute cost certainty for your operations, ensuring a sudden currency swing won't wipe out your margins. But you sacrifice the ability to capture any bonus profits if the currency unexpectedly moves in your favor. Hedging isn't a one-size-fits-all asset. It requires selecting the specific financial instrument that exactly matches your operational needs and your tolerance for risk. The golden rule of navigating currency risk is simple. You must precisely match the currency of your investments to the currency of your future liabilities. Let's look at the domestic resident or retiree. If you plan to live in India permanently, your future expenses, housing, healthcare, food, will all be priced in rupees. For this profile, there is no need to panic sell. You should maintain an 80 to 90% allocation in domestic Indian equities and use a 10 to 15% allocation in sovereign gold bonds purely as an inflation shield. Compare that to the global spender, parents funding an overseas education, or frequent travelers. Funding a dollar liability with a rupee asset carries massive risk because costs spike every time the rupee drops. You need to shift capital for those goals into US-focused index funds. Misaligning the currency you invest in with the currency you intend to spend is the fastest way to accidentally destroy your wealth. Finally, we have to address non-resident Indians who earn in a strong foreign currency, like dollars or dirhams, but send money back to India looking for safe returns. Many NRIs park their money in NRE fixed deposits, drawn in by a 7% interest rate, but factor in that 4% annual rupee depreciation, and your real return in your earning currency is practically zero. Stop using Indian debt for safety. Instead, use severe rupee weakness to aggressively deploy capital into high-growth Indian real estate or equities. You are essentially buying more assets per dollar. When we zoom out, the daily panic fades. Currency markets operate in long structural cycles. Day-to-day volatility should be ignored in favor of long-term planning. Stop trying to time the exact bottom of the rupee. Instead, architect a targeted portfolio where the mechanics of currency naturally work in the background to fund your specific lifestyle goals.